This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Out of patience, stocks tumble as hiring surges and pressure ramps up on the Federal Reserve to possibly hike interest rates sooner rather than later.
A taste for Apple. The world's most valuable company will join the world's most prestigious stock market index. What it means for you, the investor.
And a bright idea. Meet the men who are finding a high-tech solution to an everyday problem and creating jobs in the process. All of that and more tonight on Nightly Business Report for Friday, March 6th.
Good evening, everyone, and welcome. A surprise addition to the exclusive Dow Jones Industrial Average. Apple, the world's largest company, will soon join the blue chip index. But we begin tonight with the blowout February employment report and how stocks reacted to it. 295,000 jobs were created last month, many more than expected, making it the 12th straight month in which at least 200,000 new jobs were added. The unemployment rate dipped to 5.5%, a level not seen in nearly 7 years. But sometimes what's good for Main Street isn't welcome news on Wall Street. Many say the strong economic data could pressure the Federal Reserve to hike interest rates sooner than thought. That sent stocks tumbling, and how. The Dow Industrials off 278 points to 17,856. The Nasdaq down 55, and the S&P 500 fell almost 30 points. And for the week, all three indexes were lower. Now, as stocks dropped on today's jobs report, Treasury yields jumped. The dollar soared to a new 11-year high against the euro for good measure. And Hampton Pearson now takes a closer look at the labor market and what the Fed might do next.
In February, the job market got stronger despite bad weather in much of the country, a major slowdown at West Coast ports, and layoffs in the energy sector. The 295,000 workers added to payrolls last month brings job growth over the last 12 months to 3.3 million. At a town hall speech in South Carolina, President Obama called the job growth historic.
Our businesses have now added more than 200,000 jobs a month for the past year, and we have not seen a streak like that in 37 years, since Jimmy Carter was president.
Job growth was widespread. The leading sectors, hotels and restaurants, adding 60,000 new workers, professional and business services up by 51,000, and retailers adding another 32,000 new employees. However, wage growth remains stagnant. At just under $25 an hour, average hourly pay is up just 2% in the last 12 months. But Fed watchers believe job growth is strong enough for monetary policymakers to start sending signals preparing the markets for an interest rate hike as early as the June meeting.
I think that the next rate rise by the Fed is fairly solidly now for June. I think that the job data confirms what we've been seeing from client data, which is jobs are increasing and pay is beginning to increase. And I think it's only a matter of time till pay rises come through in the economy, which will be quite stimulative.
Market watchers won't have to wait long for that first signal. The next Fed meeting is just 2 weeks away. For Nightly Business Report, I'm Hampton Pearson in Washington.
John Sylvia joins us now to talk more about today's jobs report. He's chief economist with Wells Fargo Securities. John, good to see you again. Welcome.
Thank you.
Let's start, first of all, with what you think about this report and whether or not you think it does up the timetable for the Fed.
Yeah, I think there are definitely two parts to this story. So first, yes, the job number was very good. It was broad-based, except for mining, which, of course, incorporates a lot of the oil drilling. The number was very strong. The unemployment rate did decline. So from the real side of the U.S. economy, it's a good story. But I think earlier you mentioned it changed the timing, and that's where I think caught the markets off guard. It really does bring forward a lot of market expectations that the Fed could easily signal in June an increase in the federal funds rate. And that change in timing, I think, really impacted the equity market as well as long-term interest rates. And that was the second part of that interesting story.
You know, John, the stock market reacted today as though stocks can't go up if interest rates do. What does history tell us about stock market performance when rates rise?
Yeah, that's an interesting line, Tyler, because, in fact, historically, the stock market has improved as interest rates have risen, as long as the perception is the economy is pretty strong. It may be, in this case, the market over the last year or two has run up a little bit ahead of those interest rate increases, and especially now when we think about the Federal Reserve surprising the market relative to expectations. They may raise in June, whereas, you know, many people were saying no interest rate increase at all in 2015.
You know, John, one of the worrisome factors, though, is that participation rate, which is still stubbornly low, and the lack of wage growth as well. Does that worry you?
Oh, it has to, Sue, because basically it's saying, well, as you know, and probably have talked about significantly, is that there is this part of the economy that is catching on, moving ahead, growing, wages and salaries are improving, but there's another part of the U.S. economy that either doesn't have the skills, is located in the wrong spot, perhaps still suffering from a little bit from the housing, that isn't catching on. And that sort of income disparity continues to grow in the U.S. economy and does present social as well as political problems.
John, there has been, as Sue points out, and you referenced there, a lot of concern about labor force participation. But I wonder how much of that rise in the number of people who are dropping out of the workforce isn't merely because they are discouraged, but because demographically they are ready to move out of the workforce.
Yes, Tyler, there's a little bit of a challenge here in terms of analytically figuring out how much is the demographics. And we think right now it's about 1/3 is the demographics. 2/3 is just the lack of skills. And there's a little part of that has discouraged workers as well, Tyler.
All right, John, we'll leave it at there. Thank you so much for joining us. John Sylvia with Wells Fargo Securities.
Thank you, Sue.
Ty?
Well, now to Apple, the world's most valuable company, will join the 119-year-old blue chip Dow Industrial Index. On March 19th, the iPad and phone maker will replace AT&T, which first entered the industrial average way back almost a century ago, 1916. Shares of Apple rose a bit while AT&T stock fell. Dominic Chu explains now what the shakeup may mean, if anything, for investors like you.
After years of waiting, investors will now get to see Apple as part of the Dow Jones Industrial Average. The reason for the index change is pretty simple.
Traditionally, the Dow is big, major, large, blue-chip corporations, leaders in their industry sector and that kind of thing. And Apple clearly fits that mold. It is the largest corporation in the U.S., in fact, in the world. It's without question a leader in technology. It clearly fits what everybody's expectation is of a big blue chip company.
But if Apple goes in, another stock has to get kicked out. And this time it's telecom giant AT&T. That decision was a little tougher to come by.
Telecom is a bit overweight, and there are two telecom companies, and we felt we could do with just one, the other one being Verizon. And when we looked at the two of them, AT&T is slightly smaller and has a lower stock price. And those two items argued that AT&T should be the one that was selected. But it was a decision that we looked at for some time.
This move doesn't fundamentally change how either company operates or how it will operate in the future. But some investors note that there can be a silver lining for getting kicked out of the Dow. And others point out that Dow inclusion isn't all it's cracked up to be.
Historically, companies that have been put into the Dow versus those taken out has actually been a pretty reliable contrarian indicator. Going back through time, the Dow has tended to add the leaders, those that have been doing very well, and likewise it boots out the laggards. And as a result, maybe it's just a reversion of the mean, typically those names that have been removed have done a lot better than those that have been added.
As for what it means for the Dow, Apple has become the most valuable company in the world thanks to a huge gain in its shares. If that trajectory continues, that can help drive the Dow higher. So, what does Apple's inclusion into the Dow mean for Apple stock? Actually, not a whole lot. Unlike when stocks get added to the S&P 500, there aren't a lot of mutual or exchange-traded fund managers that benchmark to the Dow, meaning there won't be a flood of funds that immediately have to go out and buy Apple stock. However, if Apple's massive size means that its highest growth days are behind it, then it might not affect the index at all. For Nightly Business Report, I'm Dominic Chu.
Well, you might be surprised to learn that the Dow will actually be less tech-heavy once Apple is added on March 19th. That's because another tech company, and Visa, according to the Dow, is a tech company, it's a payments company, is splitting its stock 4-for-1. That cuts its price. It gets quartered. And because the Dow is a so-called price-weighted index, that means Visa and tech will have less influence in and on the Dow index.
Our market monitor tonight is recommending Apple to his clients, along with some other names that you may recognize. He is Mark Lucchini. He's the Chief Investment Strategist over at Janney Montgomery Scott. Mark, welcome. Nice to have you here. So,
thanks, Sue.
What do you think about Apple going into the Dow and what effect it might or might not have?
Well, we saw today it acted actually pretty well in light of a market that was down about 1.5%. So it's getting some short-term boost from that. There is, Dom said, a few ETFs that are proxy to the Dow Jones Industrial Average that are going to have to buy the stock now that's being entered into the Dow. And so as a consequence, that'll help short-term. I think longer-term, though, I wouldn't buy it or not buy it predicated upon its being a part of the Dow Jones Industrial Average. At the end of the day, I'd want to own it for the stock's own merit, the company's own merit, and for that reason, we do own it. We think that they are doing a lot of good things in terms of the product cycle they're in the midst of and what they expect to be launching here shortly. Read the watch, that is, and possibly other products, including a car out toward the end of the decade. So, the cash flow rich company paying a decent dividend that will likely increase. There's a lot of other good reasons why we think you want to own Apple stock as opposed to it just being a member of the Dow Jones Industrial Average.
You're not concerned. Apple can be a slightly lumpy company in terms of its earnings, and boy, there have been some very lovely lumps lately, but that the boost that it got from the iPhone 6 is relatively going to fade over time.
Well, I don't disagree with you, Tyler. I mean, obviously, they did get a big boost from the 6. They're going to be coming out with, likely in the second half of this year, a larger iPad to try to reflate activity surrounding sales of the iPad, which has recently started to decelerate. And of course, the watch is going to be a splash. It's obviously still open-ended as to how successful that product is going to be. But at the end of the day, the merits of the company in terms of a valuation of just 15 times, the fact that it generates about $16 billion of free cash flow on a quarterly basis, has about $150 billion of cash on its books, all together says that you can afford a little lumpiness in earnings. It's a good quality company that still has growth ahead of it.
You also like McDonald's, and I assume that you think that the new CEO is going to right the ship.
We do, Sue. I mean, with that, in lies, we think, the opportunity in the stock. A chance to maybe remake the menu, make it a little bit cleaner, and as well attract an audience, namely the millennials, who have drifted away from McDonald's because they perceive it to be not the highest quality food product relative to other options like Chipotle and so on. And so as a consequence, we think there's a chance for a new CEO to step in and make some immediate progress. And in the meantime, for investors, today with where it closed, it yields 3.5%, which is a very attractive coupon in this interest rate environment.
Give us 30 seconds on your third choice, Citigroup.
Well, Citi, of course, is a much maligned institution, failed the last go-around the stress test. This time it passed. Next Wednesday, we'll know whether it can actually begin to reallocate some of its abundance of capital back to shareholders, either in the form of buybacks or raising its dividend, which is just a token amount at this juncture. It's one of the most cheaply valued money center banks in the market today. We think it is attractive and a great value can be unlocked in the share price.
All right, Mark, thank you so much for joining us. Have a great weekend.
Thank you, Sue.
Mark Lucchini with Janney Montgomery Scott.
And still ahead, the rise of the machines as jobs become more and more automated and more manufacturers use robots. What happens to workers? We'll give you the surprising answer after this.
Consumers increased their borrowing in January at the slowest pace in more than a year. The Federal Reserve reports that borrowing expanded by nearly $12 billion in January, following an $18 billion gain in December as Americans cut back on their credit card use.
Well, Sue Staples shares fell after the retailer reported mixed fourth-quarter results. That is where we begin tonight's market focus. The office supply chain beat earnings estimates by a penny but missed on revenue. Sales hurt by a stronger dollar and decreasing demand for computers and computer peripherals. The company also saying sales for the current quarter are going to fail to match those from the same quarter last year. Shares off almost 3% on this down day. They finished at $16.05. Investors cheered Foot Locker's results. The athletic apparel retailer easily beat on the top and bottom lines, and its same-store sales surged 10%. That's all thanks to strong holiday numbers, by the way. The stock 4% higher. It closed at $59.37.
Big Lots also beating earnings and revenue estimates. Higher traffic helped bolster those results. Its guidance, however, came in below Wall Street forecasts for the current quarter and for the full year. The stock was 1.5% higher nonetheless to $48.52. And the gym operator Lifetime Fitness is in advanced talks with private equity bidders. That's according to the Wall Street Journal. The bidding, which is expected to close next week, is down to basically two firms. The shares surged up 15% to $66.32.
Well, some might call it the invasion of the job snatchers. Others will say it's just inevitable. As robots get cheaper and more sophisticated, more and more companies will employ robots over humans on the factory floor. It's a trend that will cost some jobs, but it will add many others. Mary Thompson has our latest installment of Where the Jobs Are.
A pioneer in robotics, iRobot says the industry is catching fire.
It's a very hot market.
So too is iRobot's neighborhood, Bedford, Massachusetts. 8 years ago, you couldn't find another robotics company for 150 miles. Today, executive Russ Campanello says it's a different story.
From here, this location, you could probably touch about 100 companies that are doing some form of robotics.
The change reflecting a trend seen by Boston Consulting Group. It estimates robotics spending will hit $65 billion by 2025, up from an estimated $27 billion this year. Companies spending more as robots become easier to program and easier to afford. 10 years ago, they cost $250,000. Now some go for as little as $25,000. It's an expense Boston Consulting's Hal Sirkin says can lead to big savings for manufacturers who buy into the next 10 years of the robotic revolution.
We're thinking about something like a 16% drop in the labor costs for manufacturing plants over this time period.
The industry's driving adoption: computers, autos, electrical, and machinery. How this impacts the labor market? Well, that remains a question. It's expected that some manufacturers may bring work back from overseas if they find mixing robots and humans lowers costs enough. And then, of course, the industry is hiring too.
Last year, we hired almost 100 people into iRobot. And this year, we have plans to do about the same.
It's seen strong demand for its products, like the PackBot that's used by security and defense firms, the Ava robot for teleconferencing. Hey, Charlene, how are you?
Hi, Mary, how are you?
And the Roomba vacuum. Engineer George Tall is working on 3D mapping, which he says might be used in future household robots.
3D maps would allow the robot to scan your house. If you tell it to go find your keys, it could search through that map, find your keys, go and grab the keys and give them to you.
Like George Tall, iRobot intern Eric Peterson became interested in robotics playing with Legos as a kid. Now a high school senior, he sees a future in defense.
I can see really where robotics can come into play in the military.
All this as robots start playing a bigger role in the global workforce. From Bedford, Massachusetts, I'm Mary Thompson for Nightly Business Report.
And coming up, keeping office space clean. It's a real-world problem two men believe the digital world can solve, and they're turning their bright idea into a fast-growing business. Intuit out with news. It has been contacted by Congress, the Federal Trade Commission, and the Department of Justice about its fraud issues. About a month ago, the TurboTax maker abruptly suspended the online filing of state tax returns for a day because of a surge in fraudulent claims for refunds.
A lot of small businesses are looking to solve real-world problems using modern technology. Most, though, don't have the time or the staff needed to do the basics, like keeping the office clean, restocking supplies, or finding a plumber. That's why two New York City entrepreneurs got the bright idea to provide iPads equipped with a system they built to help take care of the physical space. In just 4 months, Jose Lara's already been promoted from operator to supervisor at Managed by Q, a startup aiming to take care of the office space using a web-based iPad app. Q, remember the character that supplied James Bond's high-tech toys? In the office, Q brings a techie solution to cleaning, restocking supplies, or finding a handyman. And Jose Lara is hoping Q can be a career builder, not just a job. Since opening last April, Q has hired 175 employees. Wages start at $12.50 an hour, and Q's taking cues from the likes of Starbucks and Trader Joe's, providing benefits.
A lot of jobs that they had wasn't providing none of that. When it comes to Q, they're getting paid at a higher rate than they were normally, and now they're getting benefits on top of that.
Co-founders Saman Rahmanian and Dan Turan quickly realized hiring their own employees rather than contracting out makes it easier to train them, easier to offer them incentives, and easier for clients to communicate with them. At their homes in Brooklyn, both had issues with all of the above.
The service was terrible. I had no experience in maintenance, but as a board member of my building, I knew what type of experience and service I would want.
We were having the exact same pain point. A space needs to be run, and the way that it's done is unique in every case and often pretty broken and fragmented.
Developing the site was the easy part. Rahmanian's been doing that since he was a preteen in the early 1990s. He met Turan while both worked at a New York business incubator, Pre-Hype. They pitched the idea to about 20 residential buildings, but found no buyers until another Pre-Hype business signed on.
The schedule is here. It was a lot of managing different people, from the handyman to the cleaner to all the different players that you need to help just keep an office running smoothly.
Whitney Donaldson was managing the office, among other things, at Barkin Company, one of the many thousands of small businesses in New York City, which tend to be tech-friendly and understaffed.
Companies want to focus on running their business.
Nobody gets into business to run an office.
Hey.
Getting FaceTime with Q is probably easier for its 200 clients than it was for James Bond.
Starting today, every one of you guys can download the app.
There's also a brand new phone app. Q operators use it to check schedules and find directions to their next job. Q won't win on price at about $25 an hour. They're on par with other New York services. Instead, Q is about setting a new standard for its employees and for its customers.
We have actually added a technology layer that makes the relationship to the cleaner more personal. They can provide a feedback and say, this was great, or this was not so great.
It's transparency and it's communication, and when it doesn't exist, it becomes increasingly painful, where a generation ago, people would just assume that's the way it is. Well, it's not just the way it is. The apps are changing everything. At the moment, Q is a fast grower. The client list has doubled to 200 in the past 4 months, and they expect to begin offering the service in major markets beyond New York City later this year.
Good for them.
Cool, right?
It's great to end on a good
Uber
story
for
like
cleaning.
that. That's exactly what it is, an Uber for cleaning. We could use that around here. All right, that's it for Nightly Business Report for tonight. I'm Sue Herrera, and we want to remind you that this is the time of year your public television station seeks your support.
And I'm Tyler Matheson on behalf of your public TV station. Thanks for your support. We'll see you on Monday.